Risk come from not knowing what you are doing, but if you are willing to take that risk while the price already sold to its high, then make sure you don't miss out on all the mistakes I made along the way. Hello everyone, welcome back to my channel. I'm Rex. If you have been following me for a while, up till now you know that all my videos are made in Chinese. After some thoughts and feedback, I've decided to make a change. And pardon me, from today I'll be switching to English mode to reach a broader audience and help even more people on their investment journey. I hope this change brings value to all of you, whether you are just starting out or already familiar with the topic. It's been just over a year since I started out investing this SP500. So in this video, I'm going to share with you my 1-year journey and the mistakes I made along the way and what I plan to change in 2025. In hopes that it helps anyone here who is looking out to begin their investment journey in SP500. So let me address two common questions right off the bat. What platform am I using? I'm currently using Trade for my SP500. The main reason is because they are offering 2 free trades per month in the US stock market, which means I don't have to pay any fee when buying or selling. Over time, that really adds up in saving. Second, which S&P index fund did I choose? The thing is, there are so many S&P ETF 500 out there, which made the choice difficult. But I went with BlackRock SP500 IBV. It has an expense ratio of 0.03%, which is much lower than the SPY 0.09%. Essentially, it's just another tips of cost saving in this investment. If you are deciding to choose IBV like what I did, then you will definitely bombarded with the questions, why not choose CSPX on IBKR? Because it's Irish domicile and the withholding tax on the dividend is 15%, as compared to the 30% on the US based fund. The simple answer to that is that I'm not focusing on the dividend aspect of this investment. My strategy is more focused on long-term growth and minimizing costs. So dividend withholding tax don't play a significant role in my decision making. And now let's take a look at my 1-year investment journey in the IBV. I first started out in Jan 2023, and to be frank, it was really to test water. So I saw the return and also the fact that most of my surrounding colleague peers also in this raising game too. So at that point of time, I really know that I need to start something. But disclaimer, you really need to do your homework before buying one yourself, like what you are doing now, watching my video, learning the tips and what you should not do and should do. The selling of course not always been so smooth.
What have I done? Ow!
As you can look at the table itself, you know that the price actually plunged somewhere in the year. So over the 1-year understanding and experience, I will now share with you the mistake I made and what I plan to change in 2025. So the first mistake I've made is that I'm not reinvesting my dividend. I know that having a passive income is good, but when we are young, I feel that it's best to just invest. By not reinvesting this dividend, you are losing out the compound effect. Not to mention the dividend payout is really attractive, but you will need to ask yourself whether this investment is a long-term journey or just a short-term plan. Be it you want the cash now or opt for reinvesting the dividend for more cash in the future. Like you can opt for dividend reinvestment plan called DRIP should your brokerage allow this feature, or stock that actually reinvest the dividend straight off for you like 𝐕𝐴. And then next will be a lack of diversification. By looking at the portfolio, you are aware that large percentage of the investment goes to US market, which really poses a big risk. Aside from the downtime in 2022, SP500 still show the stability of rising positively over the years, but there's definitely still a risk out there. And the third mistake will be ignoring the expense ratio. You may or may not know, aside from the withholding tax 15% or 30%, actually there's a fee involved by investing in your SP500 ETF. So say you want to invest in ETF like VOO, its expense ratio is 0.03%, same as the IBV that I'm investing in. So what it means is that each year 0.03% of your investment will be taken by the fund to cover their operating expenses and whatsoever costs also. And you also need to know that you are not directly billed for the expense ratio. Instead, it is automatically deducted from your fund asset. So you don't see a separate charges, but it reduces your ETF performance over the time. And here is a table for you to quick look at the expense ratio across all the popular ETF in the market. So it ranged from 0.03% up to 0.09% in SPY. And the last mistake that I've learned is the emotion investing pitfall. Everyone loves quick cash, who doesn't? I myself also. I used to participate in short selling for the same reason. Not only was my energy drained, but I also find myself investing in an emotional state. ETF in fact are designed for long-term investment, where staying patient and avoiding emotion decision like buying more during market dip or selling more during market high. Whereas the S&P 500, if you look at the table, you know that it tends to move steadily over time. So maintaining a consistent investment approach will definitely pay off one. So stick to this plan and you definitely reap the reward in the long run. So what is my plan for 2025? First of all, I will definitely continue to go for dollar cost averaging. I learned this strategy when I was working as an FA selling insurance. As you know, just like insurance, when you are required to pay monthly premium for your insurance plan. So in DCA strategy, say you are investing 500 monthly. Over time, the consistent investment will average out the cost of the share, leading to a lower risk as compared to a lump sum investment. And it's particularly useful for long-term investors like you, if you are lah. So to better plan for it, as you know, I'm using 𝐳 platform to invest my S&P 500. So for 𝐳, there's a feature called Auto Invest, while IBKR is called Recurring Investment. Both of them are able to set a specific date, whereas IBKR can opt for the frequency of quarterly and annual interval and an end date, like when you want to stop this DCA strategy. So for me, this is probably the investment journey for my next 10 to 20 years plan. So I don't see an end date for it, but I also don't want to set a date, say I want to invest until like 50 years, 60 years like that. So I will say the auto invest in 𝐳 is really good enough for me. But should your preference differ from me, you can by all means choose IBKR for the recurring investment. And the next strategy for me is that I want to opt for the ETF that will reinvestment dividend. During the dividend payout, there is no doubt that it will lead to capital depreciation. So therefore, a non-dividend ETF will outperform in terms of the price appreciation because it invests in companies that are focused in growing their businesses instead of distributing dividend. Furthermore, since they don't distribute dividend, they can be more tax efficient in the taxable account. All gains are deferred until you sell your share, so reducing lower taxable event over time. And lastly, I can't emphasize this word enough, is diversification. As mentioned, US sector held the major percentage in this S&P 500. This is something that I'm wary of, like what if... So aside from S&P 500, VWRA is something in my way to hold around 3,500 stock globally, including China versus the 500 stock in S&P 500. Furthermore, VWRA is an Irish domicile and a lower 15% withholding tax on the dividend. Lastly, I want to address this final thing. You might be thinking, is it too late to start investing in the S&P 500?
Am I too late?
After all, I began my journey in 2023 when the price was around 300. I know people who got in way early bought the share around $100 or even lower. Of course, they have seen tremendous growth over time. But here's the key, the best time to invest was yesterday. The second best time is today. The S&P 500 has proven itself over decades, and while timing the market is tempting, but staying in the market is what truly matters. With a long-term mindset, DCA strategy, consistent reinvesting your dividend, you can still ride the upward trend of the S&P 500. So that's all for today's video. If you find this video useful, please give a thumbs up and don't forget to subscribe my channel. And I'm Rex. See you next time. Bye bye.